Okay, hi, I'm 𝗤𝗄𝗎 𝗃, and this is my Thursday talk. We're going to talk about Pitranomics, which is my 10-part strategy to grow, protect, and transfer wealth. The part we're going to talk about today is what I like to call send your dollars out and have them come back with friends. If you're on Facebook Live, please type in comments so that my other people, helpers on Zoom can let me know what's going on because I can't see it. And I look forward to a fun and interactive discussion. First, last week, we talked about what I call alignment, and it is a really big thing to me. I think it should be a guiding principle. If you are engaged in any kind of activities and you are in connection and partnership with other people, you should make sure that where they're going, what they want to accomplish, what they need is in concert with yours so that you have congruent goals. If you don't, it is almost destined to fail. One or the two of you or both of you will not be satisfied with the outcome. Let's see. Yeah, that is really something that I will talk about later tonight in investments, because that's what sending your dollars out into the world means. So let's start with what I think an investment is. I believe that investments are when you accumulate some funds, some money, some resources, and then you put those resources to work, that they multiply and come back. So it's really important to remember that I don't believe it's investing unless you've pooled some resources. I'm going to focus on money, cash, and whatnot. I am not going to really speak about leveraged investing, except when it comes to real estate. That is a really important topic. There are people that invest in, for example, stocks using leverage or some kind of credit. But as far as I'm concerned, that is much more risky than what I'll call traditional investments. If something goes wrong, and investments are never sure things, then you might be left in a very dangerous position. So I'm going to concentrate where there is a floor on what you can lose. You can lose your investment, but you can't lose more. I hope to have lots of interaction tonight. This is a very exciting topic, at least to me. So let's dive in. I mentioned earlier that investments are when you have accumulated a resource. I'm going to focus on money, send it out into the world to do something, and then have it come back with more money, with friends. Have your dollars bring friends. Have your dollars bring lots of friends. There's an important concept that the sooner you start investing, you have what's called the time value of money and compounding that lets it work further. So the later you start, the less likely you are to get the big rewards unless you go into an extremely volatile type of investment. So this is actually one time where I'm going to have a few notes because I know there are things that I want to cover. You can take your money and you can invest in someone else's business. You can be a passive investor where you just hand over the money with a specified return or a specified percentage. Or you can be an active investor where you participate and guide the day-to-day operations. You can invest in real estate, which is something that I do. And you can do it passively, same thing. Give the money to someone else. They go out and buy the real estate asset. They manage the real estate asset, and they just give you a distribution or a dividend, whatever it is they've decided. Or you can be a more active investor, which is what I am. I'm involved in the acquisition. I'm involved in the stabilization. I don't specifically manage my properties, but I am involved with the strategic part of managing the properties. Other investments, and I consider these investments, are like, for example, insurance policies. And not a lot of people know about it, but those that do use it very effectively as an investment tool. An example is what's called, a life insurance retirement plan. It's a type of annuity. Actually, what it is a life insurance policy with a cash value. You really step up your contributions to the premiums on the cash value, just like really fund that cash value, and then you let it grow for a while so you can loan against that cash value for income. And I don't mean income in the tax sense. I mean income that means you can use it for living. Now let's talk about income from the tax perspective. Sometimes I will say you make a lot of money, but it's not necessarily traditional income. In rough descriptions, revenue, that means the amount of money you get for all of your services, less your expenses, that equals income. If you're a W-2 employee, that your income is pretty much your wage. So those are wages, ordinary income. If you're a business person or an investor, you have to keep very special books that make sure you count all revenues, all costs of doing a business, all expenses. Then you have what's called your net income. And from that point, you start paying your taxes, your Medicare, your Social Security, and then you have your profit. So it's very important to remember that when you're a business person, you have the opportunity to put certain things in the expense column, which decreases your income. All right, let's see. There's stocks and foreign exchange. I don't know how many people know what those are, but stocks are basically shares of ownership in a company, usually on some kind of public exchange, but oftentimes they can be privately held, which means there is no exchange. And the value of the stocks depends on basically what the people are willing to sell it for. But it's very private, there's a lot less disclosure. The public stock exchange, most people know about the New York Stock Exchange. A company will say, I am willing to sell a percentage of the ownership in this company. You give us this money, you get this share or percentage of ownership that entitles you to profits. Usually it's a distribution. And if you sell the stock and it has appreciated, then you have a capital gain. If you sell the stock and it has depreciated, you have a capital loss. So you have losses and gains plus income distributions with stocks. With foreign exchange, it's pretty much similar, but you don't really have distributions. You try to buy low and sell high. For most people, that is a highly speculative activity. But there are those, sometimes called day traders, and what they do is they buy and sell, buy and sell, buy and sell based on the volatility of that currency. There are also day traders for stock. I myself focus on long-term investments, hold investments. I'm not as interested in the day-to-day volatility, but it is important to understand that concept when it comes time to use the profits for your benefit. Then you're going to be concerned about the day-to-day volatility. Another type of investing is in cryptocurrency. I will say a lot of the legal and tax laws and all that about cryptocurrency is in flux. So until that becomes a more standard form of investing, until there's what I call proven strategies for taxes that's going to stand up with audits, stand up with case law, right now it's a wide open field. I know many different investors choose the strategy that they will declare their income. I don't really know of another investment vehicle where you can do that right now, and that's just because it's still relatively new. Most of the other investment vehicles have been around a while. Another type of investment is what I like to call collectibles. Art, coins, vintage cars, anything like that that has, each item has a pretty unique and specific value that has to be appraised for its value. So there's a third-party appraiser that says this coin is worth this much, and people can pay that much or less or more. And then you, generally speaking, either put your money into that so you can hold it and transport it fairly easily. So in pre-World War II Germany, those that had massive assets, they had things like jewelry and coins. They didn't pretty much take currency. They had paintings, they had furniture, and then they would try to smuggle those out so they could have some basis of wealth when they left the country. So those are what I call collectibles. Those things that it's very hard for one individual to value it usually required some kind of licensed, experienced, revered third party to place a value on it. And the last thing I want to talk about are financial instruments, particularly notes. So usually every time you go to get a home loan, you take out a mortgage. That mortgage is a financial instrument. You have promised to pay the lender a certain amount of money each month. Some of it is payment of the principal, and the rest is interest to the lender. That is the lender's income on that financial instrument. Generally speaking, when most people buy a house and they take out a loan, that loan is immediately sold on a secondary market. Most of the time, the people who make the loan, they make their money and then they sell the loan, and those people try to buy at a discount. So let's say, for example, you go get a home loan and you pay what's called an origination fee, and it might be a point. Then the lender, the first lender, the broker, whatever, gets that point, and then they sell that loan, and the people who buy it next get the incoming interest streams. That's their income on it. So there's a whole back market of people buying these financial instruments. They're buying instruments of indebtedness that are promising cash flows. Now, the thing about that, not every cash flow is going to happen as expected, as promised, and on time. So that is why when you have a high credit rating, your loan is considered a more valuable instrument, and they'll tend to pay higher for it than they would for somebody that has a lower, credit rating. Now, in the qualified financial market, a lot of people bundle these loan products and then they sell the group of products. They sell a tape of loans. They're not buying individual loans. So they might have some really good credit, some bad credit, whatever, and then they're rated on that secondary market. So those are the types of financial investments that I can talk about right now. Is there anybody else that has a type of financial investment that I haven't shared that they'd like to put as a topic? Hey, Wilda, good to see you. Who else is on my Zoom? Shantae's there. I know you're at work. Thanks for coming. Hey, Rod, good to see you.
Shout out, Blues. Shout out.
Hi, girl. So is there any other type of investment that someone would like to discuss right now? No? Okay, so I'm going to shift this focus and talk mostly about real estate investing because that is what I do and that's what I know more about. Actually, I'm going to take a detour before shifting to the real estate investing and talk a little about a new type of investing I've gotten in, which is cryptocurrency. And my friend David, who's on here, has been in it about as long as I have. Let me tell you what I think of that. It is a wild, open field. There's money to be made and there's money to be lost. If you don't know what you're doing and you're just throwing money out there without a strategy and without guidance, it will be sheer luck that you don't lose your money. That said, I think it's a great way to put money in. I've put some money in. I would say I'm doing fairly well with it, but I haven't realized any of the profit. Crypto is extremely volatile. You are able to leverage against crypto. There are people that use credit cards to buy crypto, and there are companies that offer margin leverage against crypto. It is so volatile. I can't say that that's a good recommendation, but if you know what you're doing, if you're willing to learn about it, if you're willing to ride that bucking pony, I say good luck. Let's talk. Other than that, I'm going to move back to real estate. Now, let me tell you why I like real estate. I've been investing in Texas since 2015. That's when I started. I did have some investment properties back in the 90s before I went to grad school. And I sold those properties, I hate to say it, to fund the fact that I overspent in grad school and the European boondoggle I wanted to go on between my first and second year and the Costa Rican boondoggle that I went on after I graduated. Luckily, I was able to graduate from grad school with no student loans. No, I had a small one because, again, other boondoggles. It's not because I was broke or anything during school, but I had a full ride. I just overspent and had a blast. Maybe that's an investment in myself because I don't regret anything that I did. Sometimes I go back and I look at the values of the properties that I sold, and I'm going, you know, I could have held on to it. I don't know. That's in the past. But the property values in Colorado since 1996, I believe it is when I sold them, have gone through the roof. I had no idea they were going to become such an expensive, desired state with the advent of, how do you call it, 420 friendly laws? I don't know. But in any case, I would have had 4 to 5, if not more, times the value of the property if I had held since then. Some of them more. It's just ridiculous how much the properties have appreciated. So I am the type of real estate investor that likes to buy and hold every single property, every single one. And sometimes I go to Zillow and I look at it. Every property that I've sold or allowed to get away from me, I regret. My personality, and this is the important thing about investing, you have to choose the investment vehicles that work for you, that enable you to sleep at night, that you feel confident handling. I do not want to be, for example, a flipper. I don't particularly want to be a wholesaler. Sometimes the money is just so good in the moment, or there's another maybe non-financial reason that you want to get in, get out. But I see the true value in buy and hold. Now, before we get to that, do we have any other real estate investors on that want to ask any questions or offer something right now, disagree or agree with what I've said so far? No? Okay, I'm going forward. Here's something that's great about real estate. Historically, it is a low volatile asset. It doesn't have the big changes that, say, stocks do, that foreign exchange currencies do, that crypto does. It is amazing in that way because it's a good inflation hedge. You're also able to own it in such a ways that it makes it a great asset protection tool. What I call asset protection is the strategy that you use to hold an asset, to maintain an asset, so that it's impervious to outside assailants like judgments or anything like that. That in itself is a complicated structure that I have, but it's worth it for me to make sure that my assets are basically hidden and protected. So if you're gonna sue me and you wanna get some money, you gotta find my assets. And then once you find them, you gotta figure out how to sue me. And I've had a lot of fun and put a lot of work into my asset protection plan. If you're going to own vast resources in real estate, I strongly suggest you speak to the right kind of attorney to develop an asset protection plan. So like I said, real estate is good at asset protection. Real estate is a good inflationary hedge. The other thing that real estate is good with is because you get your revenues, your rents. There are a great deal of expenses that you can attribute to those revenue streams. And then there's a wonderful thing called depreciation, which basically says it's you use up an asset. So there's a cost with how long you've had an asset, because at some point you have to renew or fix or replace a lot of what is on a house. So now, when we talk about real estate, you apply your depreciation expense. If you structure your investment optimally, you will have your rental income, then you will have your your expenses, decrease your revenue, and then you'll have just enough for the depreciation expense to make that close to or practically a non-taxable income stream. Now, I want to make sure that that's clear. It's not that you don't have cash flow. It's that that cash flow isn't taxable. That to me is just amazing. In addition to having non-taxable cash flow, let's make sure we remember these terms. There's revenue, there's expenses, there's income, there's cash flow, there's tax liability. If you have any questions, put them in the chat. I want to make sure that that's clear. So if you as some people say, live in the depreciation zone. You have wonderful cash flow that you don't have to pay taxes on. And if you are living only on your real estate investments, any income that you show, you have to pay federal taxes. You might have to pay state and local, depending on where the properties are located. And then you have to pay basically double the Social Security tax, because if you're working for a company, your employer pays half. And then you have to pay your Medicare tax, expense levy, whatever it's called. So that's why I love real estate. Additionally, this is something you can do, and I just did a lot of this last year. If you have an asset that you purchased and then it appreciates, you can refinance that asset and take out cash. That cash you take out, and I'm pretty much using mine to buy more real estate, but you could use it for whatever you want, depending on the terms of your loan. That money that you take out is not taxable. That is a non-taxable cash flow. The people who are paying the rent in your property are paying down your loan and increasing your equity. And let's say you have 30 houses and you have a 30-year mortgage on each one of those houses. And then you stagger it so that each loan matures at each year. Now, I don't have it. It's not that beautiful, but you get my point. Then each year you can refinance, you can take the cash out. It continues to be a cash flowing asset. That money you've taken out is non-taxable. This makes it great for estate planning as well. I'll get to that a little more later. So anyway, you've got this money, say from house number one. Let's say you've got a $100,000 house. You get an 85% loan to value on it. You might clear 80%. So you've got $80,000. That's tax-free. Well, not tax-free. That's not a taxable event. You can spend that. And then the next year, you do the same with house number two. It's a $100,000 house. All the leverage has been paid down. There's 100% equity. You get an 85% loan to value. After loan costs, you clear about 80%. You cash it. You can live on that. That to me is just an amazing way to generate living expense for yourself and to generate an asset you can pass to your children as long as they want to manage the strategy. At the time that you pass it to them, and this is an exception, if I own an asset in my name and it goes through probate and it passes to my heir, there is a reset of the basis. So they don't have to pay on all of that money that's been taken out before. That's the tax laws of right now. I'm not dispensing tax advice. If you hear me talk about anything related to taxes, it's based on what I do. If you're using it in your specific application, make sure you seek the proper professional. Now, if you own this asset in an entity, an LLC or trust or whatever, then it doesn't change ownership. You pass away, your children become the beneficiaries of your assets if you structure it correctly, and then they can keep repeating the cycle. A house has 100% equity, you refinance, you take that out, you've got that money to spend. And here's the great thing. Right now, I'm still in acquisition mode. I'm going to slow down. I'm going to slow down and relax, but the money will keep coming in. Once I stop being an active acquirer of real estate, my status will change to that of a passive investor, and then I will have different tax treatment. But that's okay. By that time, I will have all this equity built in, and I will do that strategy that I told you about. This is one of the reasons I just love real estate. Now, there are people that don't love real estate. There are people that have totally messed up their real estate attempts at investing. Why is that? Well, it's important to do real estate investing the correct way. Remember what I said about living in the depreciation zone? Well, if you don't do that correctly, if you don't structure your purchase and your rehab and your refi and making sure you keep that asset up to speed, you may not be making any cash. Even though you have a depreciation zone, if your assets pretty much take your revenue down to zero, well, then you're depreciating on nothing. You can't make it negative. Now you can across a portfolio, which is why it's important to have as many properties as possible, because there are going to be years when a property doesn't make money for some reason. Last year or the year before, I can't remember, I had a tenant move out. They were doing the make ready. That's what they call it when you have one tenant leave and you make it ready for the next tenant. During the course of the make ready, my property was broken into 3 times. And those thieves were thorough. They didn't just take like carpet. They took cabinetry. They took the furnace. They took copper, sinks, light switches. I was like, dang, there is a Home Depot down the street. But I guess that particular property looked like better shopping. And I had to do that 3 times. Now, I did not file insurance claims. I did not want, the first time it happened, well, my deductible was $5,000. And I was like, well, the damage was like 7, I'll cover it. The second time I had it, I had reduced my deductible, but I hadn't had that reduced deductible long enough to be able to claim, because the insurance is like, the insurance company believes, well, okay, you just had another break-in, that could be you staged it. The insurance companies are smart. They're trying to make sure they get their money. So then we fix it again. We boarded up the house. Not we, the people who did the work, I authorized it. So we, yes. The house was all boarded up. Those thieves got back in. They boarded up the house with plywood, but it wasn't very thick. And they just, I mean, literally guys, axed, went through and shopped some more. So the house was burglarized 3 times within a month. I was less than pleased. Now, that was one house. I wasn't happy, but because I had an otherwise performing portfolio, all of those losses offset the revenue from other properties. Another thing that happened that some landlords know about is that COVID really took it messed up some landlords' cash flow. I had a little bit of a dip, but I was able, during the first 18 months of COVID, to evict 4 tenants. There were people that couldn't get them out, but I evicted 4 tenants. I'm sorry, my team, my excellent team, evicted 4 tenants. We concentrated on lease violations and holdover tenants. We could not evict due to non-payment, but we could evict for lease violations. It meant we had to be extremely diligent. I won't go into the specifics of being able to evict on lease violations, but let's say you have to make sure you document everything that happens so that you can show a pattern of disregard for the specifications of the lease, and then you can get them out. Okay, I'm going to take a little break, see if there are any questions. Oh, we've got some things in the chat. Let's look at it. Okay.
They're probably all me, Julie. How are you?
Hey, how's it going?
Good.
Okay.
I sent you a sidebar message. I'm still here. I feel like I'm always talking to you from the car. So I'm going to be in the car in about 5 or 10 minutes.
That's fine.
Driving. I do want to, because I have over 20 some odd years in insurance experience. So I do want to hear more from you about why you did not file the insurance claim the second time, even though it was a valid claim and you had decreased your deductible. It's always intriguing to me to hear from people that are not in the industry, just to kind of get their reasoning.
Fair enough. So I have you heard of master policies? I'm sure you have.
Yes.
Okay. So I don't have individual policies on my properties. I have a master policy. Now, maybe you can give me some insight, but the insurance professional that I spoke to said filing a claim would affect my master policy. Is that true or not?
Yes.
Oh, okay. Well, then he wasn't lying to me. Because if he was, I was going to get on the phone. So what I didn't want to do, oh, let me back up another thing. The properties that were broken into were in a high crime area.
Okay.
Some people don't believe in investing in high crime areas. I think as long as your numbers make sense, then you do it. So that same house that was broken into 3 times, while the tenant was there, the windows were smashed. Her ex-boyfriend, ex-relationship person came in and in a fit of rage smashed all the windows. Okay. I was concerned because I know as a landlord, I can be held liable for not making the property safe in a timely manner, even though I was not responsible for the damage. But my property manager did stay on her, and she went on a payment plan and paid for the windows. She eventually moved out. I actually let her get away because she had a domestic violence situation. So it was an unexpected turnover. Yeah. I don't know if it was someone related to her or to him that damaged and burgled the property. I don't know. But the first time it happened, I did call my insurance agent. I do know that every time you call that insurance agent, you've put yourself on their radar. So I didn't want to call again. I just dealt with it. Now, if you and I need to talk a little more, or if you can provide some advice on what to do with multiple break-ins on a property, on a master policy, or even on a regular policy, I will gladly yield the floor because that would be an opportunity to learn something.
Okay, I'm gonna send you my phone number in the chat, because I don't want what I'm going to say to you to be recorded. So I will send you my phone number in the chat. I have like 48 licenses, and so I'm not saying anything recorded. But I'll send you my number in the chat, and then we'll talk about that later.
Fair enough. Okay. Now I want everybody to realize that managing your taxes and your tax liability, managing your asset protection plan, and managing your insurance strategies are strategies with nuance. So you have to figure out what it is you're willing to do and handle it appropriately. You will get advice from the professionals. It is still your decision to make. So I love the way Awilda said, we'll talk about that offline. Fair enough. I get it. I am not giving you a blueprint for your plans. I am telling you what it is I do. I will say this again, always seek the professional, have them understand your specific situation, and then you decide with the help of your professionals what works best for you. Okay, so any questions other than that? I've kind of thrown a lot out there. I would love to get some questions or interaction.
There was, and I don't know if Awilda can elaborate, but she asked, can you repeat the strategy? But I'm not sure which strategy she was referring to. That was before.
Strategy.
Yeah.
Okay. So when we were talking about, or when you were talking about getting and I'm trying to hurry back to my notepad. When you're talking about getting the property, so you're gonna get the property, you're gonna hold it. But then there was a strategy that you were saying about something how like you can get your rent, and then you would have your expenses, and then a depreciation expense, and somehow you could pull the equity out, and then you could use the equity for whatever you wanted.
Okay, thank you. So let's put some numbers behind it so people can kind of conceptualize. Let's say you buy a property for, let's say $40,000. Okay. I wish I could, somebody write that down for me and make sure I do this right. If you buy a property for $40,000 and you have to put $20,000 in it, in both rehab and carrying costs to get it ready to rent. So by that time, your cost basis is $60,000. Right. Let's to keep it round. Let's say your cost basis is $70,000. And let's say you can get a 75% loan to value on it. So what you do is you get a $75,000 loan. there are costs associated with getting into the loan. Let's say it's $5,000. So you clear $70,000. That means all the money it took you to acquire the property, to ready the property for rent, has now been returned to you from the loan proceeds. So you have no money in it. You just have the indebtedness.
Okay.
And you have a $75,000 loan. Now that person that you put into the property pays the rent. From the rent, you pay for the debt service, so your principal and interest. You pay for your taxes and insurance. You pay for any maintenance or other expenses of owning the house. And let's say after all of that, you still get, let's make it a little number, $100 a month. So for that property that you have no money in, you have $1,200 a year income, net profit from that. And let's say 30 years after you acquire it, you still got tenants paying for the taxes, the insurance, the debt service, all of that, but you now have 100% equity in the home because the tenants paid for it for 30 years. And let's say, for simplicity, the house does not appreciate, so it's still worth $100,000. So you can turn around and get $75,000 loan to value, which is $75,000. Let's say it still costs about $5,000 to get into that loan. You've got $70,000 again. That is not a taxable event.
Got it.
So, but in reality, over 30 years, chances are that property is going to appreciate. So let's say over 30 years, it's gone up to $200,000. You get a $150,000 loan. Let's say that it's $10,000 or whatever to get it. So you have $130,000 that you've taken out in the form of a cashback refi, which is not a taxable event because you haven't sold it. Now, I have heard murmurs, especially that the Biden administration wants to start taxing unrealized capital gains. I doubt that it will happen, but as soon as it does, I'm sure that landlords are going to get together and come up with another strategy. So never fear, there's always a way to work something out. But that is what that strategy is. Okay, I think you're muted, but I saw your head go like this. So is that clear?
Yes, yes, it is. Thank you. I appreciate it.
Now, if you have 30 of those houses, you're basically living on the equivalent of $70,000 a year. Because each year, if you staggered it correctly, you can refinance this house, then you can refinance this house, and you can
the next one.
Okay. Yes. If you have all of those owned by an entity, and if say they're all owned by LLCs, and then the LLCs are all owned by a trust, and that you are both the beneficiary and the trustee of the trust, and then you have secondary beneficiaries, or who your heirs are.
Wait, Julie, you're going too fast. Okay.
Oh.
LLC. Oh, I dropped my phone. Okay. So the LLC owns the home. And then you said something about a trust.
A trust. So let me explain what a trust is. A trust is like a legal entity bucket that holds assets in trust for the beneficiary. So I can have a trust where I am the beneficiary and I am the trustee.
Okay.
So I have administrative control over the assets and I receive the benefit of the assets. Now, if I'm using this for estate planning, when I go, I'm gone, I'm dust. I have a secondary trustee, someone I trust to care for the asset. The beneficiaries, the secondary beneficiaries, are my heirs. The ownership of the properties does not change. The beneficiaries change.
Okay.
You could choose to make your heirs also the trustees. When our children were minors, that was not what we had set up. We still do not have it set up that they will be the trustee, but they will be the beneficiaries of the assets in the trust. Now, an LLC doesn't really offer that, but a trust does. It allows you to say, okay, you're getting the benefit of this entity and these assets. No, now you're getting the benefit of these assets. And you can set that up when you set up the trust.
Got it.
Okay. Sorry, I went too fast. Thank you for telling me to slow down.
Thank you for slowing down.
No problem. What else did I want to say about trust? Okay, so I spoke briefly to David about this. When it comes to asset protection, landlords will get sued. Tenants are highly litigious. If somebody slips and falls on some ice or whatever, my thought is, well, you saw it was snowing, you know, why didn't you take care of yourself? But I could be in a very far-reaching but plausible case, be held liable that I did not create a self-environment for the tenant. The tenant gets held by some shark of an attorney, and they're like, we're going to sue your landlord because they have deep pockets. And so they go to look at the asset, and what they're going to see is an asset that's highly leveraged. And they're going to be like, oh, not much money there. The attorney loses interest unless it's a really sharp attorney. And they start saying, I think there might be more. So you can't keep your assets completely hidden. But here's the information, the advice that I got. Multi-member LLCs have more protection than single-member LLCs. So if you have an asset with one owner, an LLC with one owner, and it has all kinds of assets, then it is more plausible, more likely that that corporate veil will be pierced, and they'll be able to say, well, yes, we're going after this LLC and this asset, but we're going to attach some of your other assets. If 3 people get together and form an LLC and one of the members is sued, the other 2 have a measure of protection from the judgments against one of the members. And you can have an LLC have multiple LLCs as members. And that makes it then a multi-member LLC. There are people that are advised to do series LLCs. That was not the advice my attorneys gave me. I am not saying that it is not a valid way of doing business. It's simpler.
What is a series LLC?
Sorry, a series LLC. Okay, thank you, David. The different LLCs I have all have individual bank accounts. They are completely unrelated entities. They look different, they smell different. A series LLC is all connected. You can use one bank account. You have different LLCs. There is some LLC, some limited liability protection. The case law is ambiguous as to how much protection it will give you in asset protection. So with the number of properties that,
So what you're saying is a series LLC does not give you the same corporate veil of protection because they're all associated.
No, not necessarily. There's a difference between protection and visibility. So I was also going with invisibility. I don't want anybody to know what I have, not just protect it. Because a shark of an attorney, if they can easily or somewhat easily find it, they might be able to go after you, or at least cause you some trouble. Right. Because they see that there's a deep pocket, or they feel that there's a deep pocket.
So
now, with
having said that, hold on. So having said that, who is the attorney of record for the LLCs? Do you have a lawyer listed as your, what's the term I'm looking for?
Are you talking about registered agent?
Yes, the registered agent.
Okay.
Who's the registered
agent?
So
the registered agent does not have to be an attorney. You don't have to have an attorney draft the documents. You can do it yourself. Now, I have an attorney draft the documents because I'm looking for the most protection I can get. So I have someone that is used to protecting people draft the documents. So it depends on why you're putting together the LLC. Now, with the registered agent, you can be your own registered agent if you want. But what that means is that there is someone during business hours available to be contacted and reached for notifications, for legal notices, for whatever. You represent the outward face. So someone has to be available, and you can have yourself as the registered agent, which means you need to be there. I can hire that service out, and to me, it's worth it.
But that also means that when they do a Secretary of State search, your name comes up on all of those LLCs, which makes a smart attorney start digging deeper.
Yes, if you have multiple LLCs, I don't think it makes sense to be the registered agent on all of them. But if you have just one, maybe it does, maybe it doesn't. I don't know. It just depends. But I believe if you're getting into that entity structure for asset protection, remain true to the intent and the plan of asset protection. If you're looking to it to also give yourself a level of anonymity, remain true to the plan to keep your ownership anonymous. If that's not your plan, then I can't really speak to what you should do. This, again, what I do. But I don't want someone easily doing a search on 𝗤𝗲𝗍 and saying, oh, she owns 5 houses. Well, you know what? I'm gonna slip and fall on one of them, you know.
And or I'm gonna get in a car accident with her and then I can sue her for everything.
Yes, but one of the things about being in a car accident, that's actually a good point, and I would love for 𝗲𝗍 to speak on this, and I have had someone talk to me about it. If the car accident isn't caused by determined negligence of the person driving the car, I think the liability pretty much stops with the limits of your insurance. Most people, now, I do know a very good personal injury protection attorney. And what she told me is that if they sniff deep pockets, they're going to keep going past the limits of liability of the insurance. So I'd love for you to unmute and see if this is true. But generally speaking, people think, oh, you've got $500,000 worth of liability. I'll sue you for up to that. If the insurance company pays, they do. The insurance company, I don't think, comes back and gets it from the policyholder. 𝗲𝗍, please speak on this and let me know if I'm speaking the truth.
Okay, what's the question? Is the question, once the policy limits have been paid, can the person come after you directly? Is that the question?
No, the question is, does the insurance company come after the policyholder within the limits of the liability?
No.
Generally speaking, no. So, no. And that's what you're paying for. That's liability protection that you're paying for.
Right.
So,
but there's a cap on it. So like if you have, say your policy is 100, 300. So that means you have $100,000 worth of liability coverage per person, but then it maxes out at 300,000 per incident. So if someone gets a judgment against you for 500,000, your policy is going to max out at 3, and then they may try to come after you for the remaining 2.
Right. And here's the thing that I want you to remember about judgments. I found this out the hard way.
That doesn't mean you're going to get paid.
It does not mean you're going to get paid. If they are perceived not to have any assets to attach, you have a judgment,
for you to get.
But there's nothing for you to get.
Mm-hmm.
So that's where I'm trying to be. There's nothing for you to get if you sue me. Have fun. I'm not trying to be facetious, but I spend a lot of effort in this area. I'm not careless with it at all. So if you're going to build a large portfolio, protect it. I don't I know people that will tell you, I own this property and this property and that property and all dozen over there. That's not me, because I have entered into a strategy of anonymity. So I don't say. I've had a lot of people ask me, Julie, how many properties do you own? I don't say. They might know one or two over here, and I try to mix it with handling properties for other people. So, and I do the same process if I'm keeping it, if I have done it for other people. Now, I will say I am pretty much done doing it for other people, because like I said, every single property I've let go, I remember and I regret it. I'm like, that person over there is making money on a property I sold them, and I could still be making it, but I sold it to them. And it seemed like a lot of money at the time, but it's not a lot of money. So I obsess about that, and I'm going to pretty much be, if I find it and I renovate it, I'm keeping it. So any questions anywhere? Let's see if I've.
So hey, just real quick though, in terms of buying the 30 properties, okay, would you not agree that there's benefit in paying them off early while you have active income, so you get to that refinance spot sooner for all of them?
Okay, so I'm going to say it depends. It depends on your strategy. An asset that is highly leveraged looks like a non-attachable asset. If you make a habit of paying off your leverage sooner, it looks more and more attractive. So while I say the strategy of refinancing every 30 years, I'm actually not going to do that. I'm going to keep the leverage at a certain level as part of the asset protection strategy. I'm not going to let these assets, the large ones, go all the way down to zero or even close. I'm not going to let them go below 40% or so. And it's time to refinance it and make it look even more.
Why? Explain that, please.
Because I want, if someone's looking at the house and the asset, the LLC that owns the house, I want them to think it's highly leveraged. If they sue me and say, I'm going to get your house, I was like, cool. It's a $100,000 house with $80,000 worth of leverage. By the time you sell the house and pay off a loan, you've got maybe $2,000. So the leverage against the house acts as an asset protection strategy in itself.
So at that point in time, if it got to 50, you would probably do the refinance, take the 30 back out, get it back to 80, depending upon what.
And here's the other thing. You can refinance this house, take that money out, and keep it on the business side of your finances. Remember, your LLCs have liability protection. So you spread that money out among your LLCs. No one has huge resources. So now there's one thing I'm going to add. In order to do this kind of strategy, you have to commit yourself to some pretty serious bookkeeping and compliance issues. If you don't think you're going to do that, if you think you're going to be lazy or haphazard, maybe that's not the strategy for you. So you have to keep your books in line. My books are pretty doggone good. It is not from small effort either. And I had to learn, you could hire a bookkeeper and let them handle all of that busy work. And I do use bookkeepers, but I'm going to know every square inch of my books. I'm gonna know what this means and that means. I'm gonna know when things don't look right. I'm going to be able to use my financial statements as performance indicators. And I know when I go into an interview with a lender and they're asking me all these questions about the asset, blah, 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 I can sit and confidently talk about every single one of those properties from my financial statements. And let's cover that real quick. I know I've talked about it before, but I want to mention it now. If you're going to invest, if you're going to be a business owner, there are 3 financial statements you must understand completely. They are your income statement, they are your balance sheet, and they are your cash flow statement. If you do not understand those statements, chances are you're going to be in some distress in your business. The income statement it shows your revenues, it shows your expenses, it shows your net income, it shows the taxes that you're going to pay, and then it shows your profit. So you want to be a profitable enterprise, unless you don't, but depends on your strategy. Your balance sheet shows your assets less your liabilities to show your net equity in your business. You do want that to look big. Generally speaking, you aren't taxed on equity. So it's a way to build wealth, build wealth, build wealth, and it's not taxable. You can choose how you take cash from those assets. What it does is it decreases your assets, increases your liability. You've taken that money out in cash, but it's not a tax incident at that moment. On your statement of cash flows, as with any business that has variability, there will be times when you have high cash and low cash because you'll have high revenue and expenses. And you want to make sure that when that revenue expense mechanism is going through, you're not ever out of cash, that you can't cover your expenses. Can't do that. That's not a good way to play. So you want to make sure on a high revenue month, you pay your expenses, you have stuff in reserves. So let's say revenue slump, you pay your expenses, you make sure you're still above ground, you have a high revenue month, you have to be able to predict, you have to have resources available in the event of low revenue months or high revenue months or periods. So a lot of the problems with landlords when COVID hit, they were highly leveraged, they had no resources, and the revenues dropped because tenants weren't paying. I don't even know how that became a thing. That whole trend is very disturbing to me, that is what happened. And so basically the CDC was able to say you cannot evict people for failure to pay. I am probably going to transfer, and I haven't done this and I said I'm going to, all future loans are going to have provisions. They're probably going to be shorter term because you can get out a holdover tenant. Holdover tenant means they're still there when their loan has run out. They no longer have the right to be there. And I'm probably going to put more responsibility of certain maintenance on the tenant. You clog a toilet, you pay, don't even call me. Your light bulb goes out, I don't care. Your microwave or dishwasher goes out, I don't care. Those are things that really run out due to use. If it is functional and working by the time I give it to you and your use has caused it to fail, then you will cover the expense. Now, let me tell you about a landlord discussion that I was in, I want to say 3 months ago, right? They were saying that it might be difficult to write such a lease. It is not difficult to write such a lease. You can write whatever you want. You make sure you fully disclose and you show that you fully disclose to the tenant what's happening, and you make sure that you are consistent in enforcement. And then it's a powerful tool. If you are not going to be consistent in enforcement, and the case can be made that you're punitive against one person and not another, you've taken the teeth out of the power of your lease. So be consistent. And you know what? Don't let sob stories sway you, because that will hurt you not only with that person, but with your other tenants. Consistency, consistency, consistency to your strategy. Does anybody have any questions about that? Okay.
Yes. So when it comes to sob stories, and I'm asking based on an assumption that I have, is that that's why it's always a good idea to have a property manager, so that way there's another layer. And if they're communicating it to you, they're communicating it to you without the emotion, versus they're hearing it with all the emotion from the tenant. By the time they relay it to you as the landlord, you're like, oh, well.
Right.
Is that accurate?
I know that the landlord will throw the owner under the bus every time. They'll say, well, you know, we would, but the landlord has said no, and we can't do anything about that. And I'm okay with that.
Yeah, I was gonna say, I would probably be okay with that.
I'm okay with that. And some people aren't strong against a person's desperation. I'm not saying that there aren't people in dire straits that have legitimate and unforeseen problems. I'm just saying it's not my problem.
Yeah, but
For
me,
you can't give that inch, because then it will become an avalanche upon you and make you fail in your business.
And that's why I know for me, I will definitely need a property manager for that reason, because I probably would bend and sway, because I'm like, oh my goodness, you poor thing. But if I have somebody, a buffer in between to take the emotion out of it, then I'm probably more likely to be like, oh, well, hey, it happens.
Yeah.
You know?
Isn't that where the anonymity comes in? Because even though you're the owner, you don't have to disclose that you're the owner, and you can say, well, let me get back with the owner and see what the owner says, and then come back and say, well, the owner said that they can't help you. At that point,
another reason for having a property manager in place, a good property manager, good professional, is that they know how to be even keel with everybody to project the consistent application of the strategy and make it so that that doesn't seem like they're showing favoritism to certain tenants. It is almost impossible for the owner to do that. Now, maybe there are people that can be cold-blooded 100% of the time. You're like, it's all about the details and the numbers. I know that there will be some story that resonates with me, and I'll feel like, oh, maybe. So I don't even want to hear the story. Just like the situation with the domestic violence, yes, I felt sorry that she was suffering from this horrible man, but I didn't choose him. So I don't know why is that my problem? I didn't choose him.
The other thing is with the anonymity aspect, you can go visit the properties as an inspector and see what's really happening, because they don't know who you are. Therefore, when you ask a question, well, the owner won't do this. Woo, woo, woo. Go ahead, speak on that.
I would say yes, you can. I would say unless you have rigid control of your emotions, I don't suggest it. Let your property manager do your inspections, take good pictures, and let you know what's going on. Now, there have been times I've wanted to see a property, and there were specific reasons, but for the most part, you don't want to be interacting with the tenant, period. I don't have the vast experience with fair housing, with staying consistent with whatever it is the property manager has told them. I could very easily mess up their game. So I try and stay out of it. Yeah. Hold on, let me check. I tried for leverage, inflation. Oh, yes. I want to talk about some performance indicators with real estate investing. So there's what you call your cash on cash return. The example that I gave with the $75,000 loan to value, basically $70,000 cash out, they have no cash in the deal. So their cash on cash return is an undefined number because you're dividing by 0. But let's say that renovation cost them $80,000. They got a 75% loan to value. They got $70,000 from the loan proceeds. So they still had $10,000 in the deal. And let's say their net income for the year was, after all their taxes and insurance and maintenance, let's say it was $500. I'm just using the number, $500 over 10,000. Somebody tell me what that is. Is that 5%? I don't know, let's say it's 5%. So that's a 5% cash on cash return. No, it's more than that. Somebody tell me what that is. $500 over 10,000 takes 20. So that's 2%. I don't know, whatever it is. Sorry, my math brain isn't working. Somebody want to tell me what $500 divided by 10,000 is?
5%.
5%. So it's a 5% cash on cash return. Remember, I think I said earlier, no, I didn't. I try to shoot for at least a 15% cash on cash return before I even will look at the property. It's got to do at least that. I'm not looking at anything less than that because things will go a little off. So you want to make sure you are not negative. I don't want a negative property. I don't mind a low cash on cash return. In my particular instance, I don't need the cash from the real estate properties to survive. That is my situation. If you need to survive on that, then you need to probably up that to 20%, 25% cash on cash return. Another performance indicator is return on equity. So let's say you have $500 for the year. The equity you have in that is, in that particular case, you have $20,000 worth of equity. So it's $500 over the $20,000. That's the return on the net ownership that you have. So the asset value less the expenses, that's the return on your equity. I don't care about return on equity because it's not going to trigger a buy or sell, a sell decision for me, how much equity it is. I'll just refinance it. And I will refinance a property where the principal, interest, taxes, and insurance are higher than the rent. Can anybody tell me why? Then it looks like it's a non-cash flowing property, but why might I do that?
Because you can refinance it.
Because I have the money.
To level your net income.
Well, that, and to make sure the asset looks leveraged for my asset protection strategy. And then I have the money sitting in the bank. I'm like, for those lean months or those negative months, I just use my reserves and pay it out. That's not everybody's strategy because they're not in my situation. They don't have my goals, but that is mine. There's the return on, sorry?
Speak on reserves. That's huge.
Oh, sorry. Yes, thank you.
When you
are a real estate investor, you have to have a cushion because stuff is gonna happen. So you need to be able to address the needs of your portfolio, even though the cash coming in for the period doesn't address it. So when I talked earlier about the property that was broken into, there was no income coming in from that property as it was being broken into. It was empty. If I didn't have any money set aside to renovate it, I wouldn't have been able to renovate it and turn it back into an income producing property. Now, here's the thing that I really want to be subtle and detailed about this when it comes to make ready. In general, make ready is an expense. It's an amount you can take off your revenue to decrease your income. But if you're doing significant upgrades, that becomes a capital expense. That is not expensed off your revenue. That is increasing the cost basis of the asset, and then you can depreciate that increased cost basis. Is that clear? So let me say it again. If I have a house that I'm making ready, I've got to, I don't know, clean the bathroom, maybe epoxy the tub, and replace a sink. Those aren't considered significant or material improvements to the property. They become expenses. So your total income for the year, less your expenses, it increases your expenses, so it decreases your taxable income. Now, with the case of the break-in, if I had said, well, I want to replace the cabinets and the sinks and the furnace and all that without a break-in, that is considered an improvement, not a make-ready. That becomes a capital improvement. You can't expense that in the current year. You can only expense the portion that is depreciable in the current year. But because it's a casualty, it's an expense. Booyah. Okay, so I'm going to go into one thing. I know David likes this story. So in 2021, no, 2020, December 2020, I bought a snazzy new car. What I wanted to get was another Toyota Sienna minivan. I had planned to drive those things until I died. But in 2021, they changed the Toyota Sienna to something that I didn't want. So I'm like, okay, now I will consider another car. My CPA said, buy one that you can fully depreciate in the current year. These are your specifications. Has to be 6,000 pounds or more gross vehicular weight. So I was like, what cars are, so I looked at those cars. Not a lot of them impressed me. Trucks and vans are one of them, but there were two cars that did. There's the one that I have, which is the Mercedes-AMG GLE 53. Yes, there's that. And then there is the Alpina BMW X7. I'm sorry, I don't keep up all those names. But anyway, what that means is that if that vehicle met the specifications, you don't depreciate part of the vehicle each year. You depreciate 100% of the cost of the vehicle off your income. So let's say you buy a $150,000 car. Your income otherwise would have been $170,000. You take that $150,000 right off the top. Doesn't matter if you pay for it with a loan or not. You take it right off the top. Your income now becomes $20,000. You have fully depreciated that car in the current year. If I had bought that Toyota Sienna, I would have only been able to depreciate, I think it's 18% in the current year. I giggled my way over to buying that car. I was like, yeah, this is a tax deduction. Only thing is they're going to sunset that particular depreciation. It's called special accelerated depreciation. They're planning to sunset it beginning the year after this one. I don't know what's coming next. I will stay on top of that because that is kind of a cool way to put expenses in your income determination.
So I need to go ahead and get that car now, huh? So I need to go ahead and get that car now, huh?
Well, okay, so it's really important that you stay on top of your books because here's what I did. I bought that car in December of 2020, right? You are able to depreciate it based on how much you drove that car for business in that year. So I bought it in December and that car did not move unless it was for business. So I got to depreciate 100%. So you have to track your miles, your business miles and your non-business miles. So the advantages to the game are knowing the rules of the game and the advantages of following the rules and taking advantage of, I won't call them loopholes, the provisions that enable you to do tax mediation strategy. So you have to stay informed, you have to stay diligent, you have to be consistent and thorough with your books. If you're not going to do that, you're not going to be able to take advantage of it. I actually went to a seminar, I think it was 2018, 19. It was a 3-day seminar. They covered asset protection, tax mediation, a couple other things. And I brought this book. And I actually was organizing over there and I found that book again. I was like, it's time to read that again. And it gives you all of these tips for your bookkeeping. It's time to give that book a quick perusal. Don't you think? It's been a while since I looked at it. Obviously, because it was just on it when I found it.
What's the name of it?
Hold on just a minute.
Sorry, guys.
That's fine. I want to know too.
You know I'm gonna ask, right?
And I'll also tell you that I took it to a copy place. So this is the original book. and they have an updated version. It's called the Tax Reduction Workbook by Scott M., and I don't know how to pronounce his name, Estill. Okay, and so I had it separated so I could put this book in something that I could write on. And then this, and it just so happened I was organizing and I had this book. So once again, the Tax Reduction Workbook by Scott M. Estill, E-S-T-I-L-L.
Was that the wealth creation and asset protection workshop?
Mm-hmm.
Is that what that was?
Mm-hmm.
Don Pendleton?
No, this was Anderson Advisors.
They work with Don Pendleton.
They do. And what's that guy's name? The blonde guy. Name is gone. Sorry. I normally know his name, but I can't think of what his name is now. Yeah,
but Anderson Advisors works with Don Pendleton in that group. So yeah.
Yeah, the guy I talked to, and I can never remember his name. It's a very interesting Italian sounding name. He was great to talk to about my specific situation. Because at the time that I started my strategy, I was in a lawsuit. So, okay, any questions? No, this was fun. I'm sorry there weren't more people on, but I did hear from a friend of mine that she looks at it when it's recorded. So I hope there's some value here. If anybody has any questions after we reviewed it, you can put them in the comments. I will address it, or send somebody else to address it. This has been fun. I hope that everybody got something from it, and I will see you next week. It is my hope to have, her name is Amy Sayer of August REI. She is a loan servicer for owner finance loans. It's fascinating what she knows. She was supposed to be on this week, but she didn't feel well. So you got me and my talking, because I can talk every day about this, but sometimes I need for you guys to hear from other professionals. Hopefully she'll be available next week. If not, it'll be me or somebody else. If anybody doesn't have anything, this has been fun. Thank you for coming.
Thank you.
By the way, Shamir, that meme or whatever it is that you posted with the eagles soaring, that was amazing. I'm going to share this for the recording. My mother was a fantastically smart woman. I don't know anybody like her. And she had these sayings, and one of them was that eagles don't soar in flocks. The reason why she told me is because she recognized that I was also a very intelligent and special person. I'm not usual. I'm going to seem weird, a little dorky, a little strange to most people. She said, I don't want you to keep other people's opinions. She doesn't want that to keep me from soaring. Learn not to care about what other people think and soar, and get used to soaring alone. Eagles never soar in flocks. It's the mediocre that soar in flocks, not the superlatives. My thought is, I need me some eagle friends. I want to soar with some people for a time. And Shamir posted a meme of these one eagle soaring, and then they were holding hands with another eagle. It was just perfect. Thank you. But let's soar together, at least for a while. Let's build each other up. Let's bring value and take value. Let's all grow together. Let's become wealthy in every sense of the word. This is why I'm doing this. It's the reason for the community. And I hope you guys are in it with me. So thank you for coming. I'm going to say good night and close it out. Take care.